Businesses and corporations are often built around achieving specific targets and are driven by incentive systems. If you hit your sales numbers, you get a bonus. If you meet your production quota, you might get a promotion or simply keep your job. These systems can be powerful motivators for productivity and innovation. However, when the pressure becomes too intense, when goals are set unrealistically high, or when the only thing that seems to matter is hitting the numbers, these same systems can inadvertently create a recipe for widespread unethical behavior. A culture that prioritizes performance over ethics, where success is measured solely by metrics without regard for company values, can compel employees to bend or break rules. A stark example of this is the Wells Fargo account fraud scandal that came to light in 2016. For years, thousands of Wells Fargo employees were subjected to immense pressure to meet hyper-aggressive sales goals. A core part of their strategy was a mantra known as 8 is great, signifying that every customer should ideally have 8 Wells Fargo financial products. The pressure to achieve these cross-selling targets was relentless, with employees facing the threat of job loss if they failed to meet their quotas. What was the result? To survive in this high-pressure environment, thousands of employees resorted to unethical and illegal practices. They opened millions of unauthorized bank accounts and credit cards in customers' names, often without their knowledge or consent. They even engaged in practices like forging customer signatures, creating fake PINs to activate unauthorized debit cards, and moving money between accounts, a practice known internally as simulated funding, all to give the appearance of meeting those demanding sales targets. In this case, the system, characterized by unrealistic sales quotas and intense management pressure, directly and systematically rewarded unethical behavior. Opening fake accounts was the most direct way for employees to meet the metrics that determined their bonuses and job security. Disturbingly, investigations revealed that senior leadership within the community bank division was aware of these gaming practices for years, but often minimized the problems, sometimes framing them as isolated instances of individual misconduct, rather than a systemic issue stemming from the sales model itself. Some even viewed the negative consequences of these practices as a necessary cost of doing business to achieve increased sales. This illustrates a profound failure of leadership and a corporate culture where short-term profits were prioritized over ethical conduct and customer trust.